Hello and welcome to Livewire's Buy, Hold, Sell. I'm Selby and today we'll be analysing 3 stalwarts with 25 years of history or more on the ASX. Plus our guests will also be naming a stock that is no longer in their good books. And to do that we're joined by Anthony Aboud from Perpetual Asset Management and Catherine Allfrey from WaveStone Capital. Okay, first up today we have Macquarie Group. It listed on the ASX back in July 1996. Kath, starting with you, is it a buy, hold or sell?
Look, I'm going to go with a buy. It's had 2 downgrades following a record year last year, $5.2 billion. But we are coming to a turning point. So this result will not be good. 1.6, 1.7 billion, down sort of circa 30%. But from here, you should see a base form, and the businesses that have underperformed, like Macquarie Capital, like the trading business, Commodities Global Markets, should perform better from this turn here, as well as the asset management business. We'll see some good asset realisations in the second half, which will see Macquarie turn. So I'm back on the buy track with that one.
Okay, 65% of brokers agree they rate it as a buy. Anthony, over to you. Is it a buy, hold or sell?
I've got it as a hold. I think it's a company you can't back against. They always manage to reinvent themselves. From an analytical perspective, looking bottom up, it's very hard to analyse because every year there seems to be one-off type profits like performance fees or profit on sale of assets or polar vortex profit from trading, etc. So they always manage to get these one-offs. The reason I'm a bit more circumspect about it is with higher interest rates, they do tend to have a lot of longer duration assets, both within their funds, but also on their own balance sheet. Having had 2 decades of, I think, sort of tailwind, this higher interest rate's probably a bit of a headwind for a lot of those sort of one-offy type profits over the next couple of years. So I just think it's going to be harder for them to pull a rabbit out of their hat. So for me, it's a hold.
Next up, we have Aristocrat Leisure, which was also listed in 1996, but was founded long before that. Over to you, Anthony. Is it a buy, hold or sell?
I am going to sit on the fence again, sorry. I've got a hold on Aristocrat as well. Look, we over the next short term, we think that the land-based earnings are going to be very, very strong. And we also, so we think that there's good momentum and the stock's derated. However, over the medium term, there's a few issues that we've got sort of facing Aristocrat. The first one being they have lost a lot of staff, key staff, both in research and development, but also in managerial positions. The second issue we've got is that their competitors actually on land-based have improved. And you've actually, for the first time in probably a decade, they're well capitalised and got good management, specifically Light & Wonder. And finally, we don't believe there are the same sort of barriers to entry on the digital side as we do on the land-based. And so, yes, it's derated. It's about 20 times PE, but we don't think it's enough for us to get too excited on Aristocrat. They prefer Light & Wonder.
Yeah, even though it's derated, the share price is still up around 28% to year to date, and 87% of the brokers who covered the stock rated as a buy. Kath, over to you. Is it a buy, hold or sell?
Well, I think I will stick with the consensus and go for a buy. I think the result's going to be pretty good by the sounds of it. And we like the new acquisition, Neo Games, and the space that they can go into in terms of iLotteries. I agree with Anthony in terms of increased competition, particularly for games like Raid for Aristocrat. But overall, at 20 times, given its sort of growth outlook, we think that's reasonable for the stock, and we still think that it's a buy.
Okay, last up for today, we have James Hardie. This stock has been remarkably resilient considering the volatility we've seen in housing over the past 3 years. Is it a buy, hold or sell?
Look, it's a hold for me. It's so dependent on what happens in terms of US interest rates, but most households are locked in around 3% interest rates. And if 2/3 of the market for James Hardie is all about renovation, remodel, as they call it in the United States, and so therefore that market should get a boost going forward because a lot of stock, over 44 million homes in the US, are over 40 years old. So that remodel renovation cycle should be coming through because there's no way that US homeowners locked in at 3% interest rates are going to move home because currently the interest rates are around 7% in the US. So for us, we do like it, but it's had a fantastic run, and we are a little bit concerned about obviously the consumer outlook in the US being slower, but was going to sit on the fence and hold.
Okay, this stock has the longest listed history of all the stocks we're talking about today. It was listed on the Sydney Stock Exchange back in 1951. Anthony, over to you. Is it a buy, hold or sell?
Well, it brings a tear to my eye, but I'm going to say sell. Even longer, I think the company formed in 1888. It's an amazing Australian success story. We think, obviously a dominant market position in the fibre cement siding market and taking market share. There was obviously a little bit of a kerfuffle with the change in management maybe 18 months ago, but the new management team seems to have allayed fears, and the margin outlook in the last quarter was very promising. However, this is a cyclical business. And yes, Catherine's right, that 2/3 is R&R, but the 1/3 is new homes. And the 30-year mortgage rate in the US is just under 8%. So I think that's going to result in obviously a downturn in new housing, but also just sentiment towards housing and housing stock, and consumer sentiment will turn negative. And when that happens, we do feel that people spend less in their home. But time will tell. We just feel that it is a cyclical company, and even though it's a high quality company, it is still cyclical. And I feel that it's quite well held, and that people will probably be surprised by the cyclicality of it at some point.
Okay, we asked our guests to bring along a stock they've covered for quite some time, but it's no longer in their good books. Anthony, what have you brought for us today?
Yeah, Amcor. Look, we have owned it, in the past. The thing which concerns me about Amcor, we feel that it's been, from a capital management perspective, it's been managed as if low interest rates will stay there forever. It's got $6 billion US of debt, and it's about 3 times debt to EBITDA. It's had 1 or 2 downgrades. Feel that it falls into the basket at the moment of a company where some of these inflationary pressures is going to start to hit home on the cost side. That's labour, interest rates definitely. On the other side, you are seeing volumes. It's a destocking event going on at the moment. We're seeing high single-digit decline in volumes, at the moment. And whilst it does have exposure to Gatorade and fizzy drink, I also don't think that's a negative. Everyone's worried about GLP-1, what impact it's going to have on people's consumption of fizzy drink, etc. I'm not as worried about that, but what it shows when you're as geared as high as that, you don't need any headwinds at the top line. So that's one which sort of we have liked in the past, but we're a bit more on the negative now.
Okay, over to you, Catherine. What stock is in your bad books?
I don't know if it's in bad books, but I just think that the market's underestimating the impact. That would be AMP. In terms of AMP, now 55% of it is the bank. And small banks in Australia are doing it exceptionally tough at the moment. You only have to look at the Bank of Queensland result, where you saw a 20 basis point decline in their margin. Yes, AMP have called that out, that there will be margin decline in this half. However, the problem is it is actually accelerating. It hasn't actually stabilised yet. And for small banks also, they're facing the increased cost of cyber security, as all banks are. But if you have to do that as a small player, as a percentage of your overall costs, that is actually a lot higher. And so we think costs will be higher than the market expects. We think margins will be lower than the market expects. And the other interesting thing is that the buyback is finishing. And so we think it will be unlikely that they'll do another buyback whilst they have these class actions that they're currently mediating. And those class actions they can't provide for. So that's why they need that surplus capital to come back. So for us on 13, 14 times, it's just too expensive given the earning risk.
Okay, that's all we have time for today. I hope you enjoyed that episode of Buy, Hold, Sell as much as I did. If you did, why not give it a like? Remember to subscribe to our YouTube channel. We're adding so much great content just like this every single week.